you know, I was really confused about dimensional the first time I heard about dimensional, because I always thought I was pretty like obsessed with fund managers and trying to generate alpha, and you know what the hedge funds are doing, the quant funds are doing, the passive indexing is doing, and at the time I had sort of conceded to the fact that I would be a passive indexer for life because I care so much about efficiency. And then a friend told me, oh yeah, these dimensional guys, they manage like $700 billion. I was like, $700 million? No, $700 billion. And I was like, why is it that no one's ever heard of them? Why?
Oh, that's a question for me. Thanks, Greg. My journey was much the same. I've been working with Dimensional for 17 years, and before that, sort of a decade or so in traditional active management. And I thought I had a pretty good feel for the landscape as well. And so we were a best-kept secret then, but I think we still are today. So thanks for having us on stage. So, Dimensional, we manage about $700 billion, and my colleague Joel Kim will talk you through how we're different from an investment approach, from traditional passive or traditional active, kind of blending the best of two together. But our distribution strategy is very different as well. If we think about the way that investments are sold or distributed, it's take a great idea with good short-term performance and pay salespeople to sell that to clients. Dimensional's investment philosophy is very different, and the only people who are really interested in it, because it's not the traditional approach, are people who are fiduciaries. So our natural client base is, sovereign wealth funds, large institutions, or fee-based wealth managers. And traditionally, there hasn't been a lot of fee-based wealth managers in Hong Kong. We don't pay commissions, we don't advertise, and we don't really have any kind of robust retail marketing presence because we don't have any inclination to do so. What we try to do is look for partners who are sophisticated investment management professionals who are looking for the best solutions for their clients to give them long-term exposure to asset classes with the hope of getting the return of that asset class or better. And we've been at that for 40 plus years and researching it for even longer than that. So that's why you haven't heard about us.
Okay, so 40 plus years. Walk us through a bit of the history of Dimensional over those 40 plus years and what makes the investment approach so different.
I'll let Mr. Kim take this one. Why don't you kick it off?
Yeah. Well, I mean, you've heard a couple of things from my colleague Wei Dai already that should give you a little bit of a taste of like how we're different. You use the terminology evidence-based investing when you talk about like what sort of investment belief do you have at Endowus. So there's probably multiple like ways to define that, but a typical one is backed by like based on like academic research and then backed by empirical evidence. So that's typically rules-based, transparent, well-diversified, and then when you think about like what are the different approaches under that, index investing could probably be one of it. Then the other one that we have pioneered with the academics that Wei alluded to, the founder, David Booth, who started the firm in 1981. I think you've got a Chicago business school here named after him in Hong Kong as well. And so at the firm, we've pioneered that like way of like investing. It's probably better known as factor investing by now, but basically using a reliable return driver, structuring portfolios around them, and then harvesting premiums that you associate with that. And so that sets us apart in the sense that, and I've got a traditional active background, like prior to like me joining Dimensional, I did the forecasting for like 90 years, traditional like analysis. At Dimensional, we take the guesswork out of it. So it's rules-based, systematic. We are active as in trying to harvest the premiums, but we stay away from like making subjective forecasts like what the market will do, tell people to go in and out of markets, and ultimately that gets you to an investment outcome and an investment, something from an investment belief perspective that gets close to what you tell clients is a good way to invest. Long-term asset allocation, focus on low cost, remain disciplined in your investment approach, And that usually gets you to like the best outcomes for clients.
So, I mean, I think low cost is one of the things that have always drawn me to dimensional, where you could get systematic diversification in over 10,000 securities for 30 basis points or so, which is pretty incredible. And I was very surprised that this existed when I finally did learn about dimensional. When we right about when we were starting Endowus, actually.
I remember that.
And I think one thing, and doing a lot of research before, really going deep into partnering with Dimensional at that time, was actually a very interesting story, which is the foundation of the first index funds, the people involved in the first index funds in the early 70s, and how that's evolved over time. So maybe you guys can share a bit of that story.
Well, yeah, the founders of Dimensional, David Booth and Rex Singfield, were closely involved in launching the first index fund. I think what academic research focus on after that is like you can probably do a little bit better than that. So what we do still has the same characteristics in terms of low cost, very well diversified. But then there's things over and above, like indexing. So indexing in many ways, you could consider it as better than what a lot of like traditional active guys do. Transparent, rule-based, cheap. But I think at this point, and there's a lot of money that has gone to passive, and like what is the most like important reason is probably low cost. And what people then focus on when you think about costs is the explicit cost that you see as in a low management fee and a low expense ratio. And I would argue then as in like cheap is good, is cheapest the best? I don't know how many people here like sushi. Do you eat the cheapest sushi that is out there in the 7-Eleven? Probably not. So we did actually, and Wei has spent quite a bit of time with this with research as well. If you look beyond like the explicit costs within a fund, and you look at, think about like why did people come up with an index? These indices were built so you had a benchmark for active guys to be benchmarked against. It was never meant as an investment vehicle on itself. And so I just want to give you two short examples as on like the limitations and having some flexibility around like just pure slavishly tracking of indices. One is the reconstitution effect. Now, let me walk you through a quick example. Like say take Tesla in 2020, right? Started the year at, I think, 30. It was already a top 60 stock, and it was not included in the S&P 500. So the market cap, they qualified, but S&P has additional criteria. So you need to have 4 quarters of positive profits before you can be considered to like be included. And so around November, Tesla met those criteria, and that stock was not at 30 anymore. It was at 130, and by the time they announced it at that point, like, we're going to include this in the S&P in a month's time. Guess what? By the time it was included, the index manager would have had to buy it, because you got to minimize tracking error, at 230. Now, Tesla is trading at 157 or something right now. And listen, I mean, we don't have forecasters on, like, we knew that it was going to get to 230. But I think this is a really good example, as in some flexibility and not just blindly tracking an index, is one of the drawbacks there. The other one, and then I'll stop talking, is the thing around like rebalancing. We know that, again, like around reconstitution date by an index provider, that an index manager will pretty close to the close of that day buy or sell stocks around that rebalancing process. And it's a little bit like, yeah, Valentine's Day, and I'm sure people have bought flowers on that day. Do you buy for more money then at that day or less? I think that's another example.
I don't buy flowers on that day. My wife's not very happy about that.
Okay. All right. So in any case, just to finish up, I don't want to gang up on. There's tons of smart people that do index management. I think echoing what Wei said, There's a lot of stuff that we have in common with index managers. There's a low-cost, transparent, diversified. But I think we've got a pretty good proposition to add something above that, what an index manager typically cannot do.
So, I mean, theory is great. I mean, obviously, it almost seems like David Booth at that time would have been much more commercial, sticking to indexing,
Right.
because indices are now, you know, tens of trillions, dimensional 700 billion.
Yes.
And theory is great too. So, you know, 4 or 5 Nobel laureates implementing their academic theory in markets. And does it actually produce better returns after fees for the client?
Yeah, thanks, Greg. I think your dimensional DNA, it's about matching the theory, as we've heard from Wei and Joel Kim, around how secure is the price, what drives differences in return, and really trying to understand that, and then also having it supported by the data. So if you go back to the early days when you know, some of the academic colleagues from Chicago, David Booth and co, launched the world's first index fund in 1971, that wasn't, I mean, they weren't flying off the shelves. That was, you know, a very different concept at the time, to go and buy the market and hold it. So people didn't know if that would work. And most of the industry were challenging, you know, whether that could give you better returns than traditional active management. So, yes, we did pioneer that for a number of years, and you know, it's turned out that indexing is a great idea. But as a colleague from Amundi said earlier, if you just want to index, you close the door on the opportunity to outperform. And there's many different views on what, you know, how you can do that. Dimensional's approach is to look at the evidence, to understand the theory, and over the long term, it's worked out very well for dimensional investors. So our, you know, the first strategy we launched were in 1981, and we've never closed a strategy, and we have investors that are still investing with us today over that 40-year track record.
Yeah. So that was a unique feature. I mean, I've never met a fund manager who was proud of never closing a strategy, but actually, if you are in the industry, that means a lot. And I know a lot of us in the audience are in the industry, and they've been, you know, when they say close, it doesn't mean close because it's capacity constrained. It means they shut down the fund because it underperforms for whatever reason, or it doesn't make sense anymore. And Dimensional never closing a strategy, or shutting down a strategy, I should say, speaks to I think the integrity of the firm. I was also, in preparation for this panel, I was doing some research on, you know, how that 1981 strategy is doing, and if it's true that they never closed the strategy. And it actually does still exist. It's a fund focused on US very, very small cap companies. And I think as of March, it breached 100x from when it was first founded in 1981. 100x. So the NAV had actually increased 100 times since 1981, just under a 12% annualized return in that period. And what was interesting is the Russell 2000 did about 55 to 56x, which is also a fantastic, you know, outcome. But I think it goes to show that implementation does matter. Yeah.
Yeah, I think the ideas that we try to share with our investment partners are, you know, what are those drivers of return? And they're evergreen, as Wei explained. It's explained by sort of valuation theory. And if you have a plan, if you have a strategy and the discipline to stay invested in the asset class and tilted to those exposures over time, you know, history's shown us that you can do better than the market without outguessing the market. And that's really what we're all about. There's differences in return, they can be harvested, but we don't need to speculate as investors on when to get in or out of the market or in and out of, you know, a particular strategy if you're committed to that. And I think one of the great things that Endowus is bringing to Hong Kong in a very scalable way is an independent voice that helps clients understand what their goals are and construct solutions that are designed to get them where they're trying to go, not whether the market's up or down, but harvest the return of the asset classes you're invested in, which is great, and we need more of it.
Yeah, so I mean, I think from our perspective, they've always formed good building blocks for our portfolios. They're not the entire portfolios. We have passive indexing, we have active elements as well, but I think the Dimensional the dimensional funds form good building blocks where we know we're going to be compensated for the risk that we're taking, and we're paying a fair price for that. And we always wish the price could be lower. As we scale, we hope that we can keep on putting pressure on dimensional to lower fees too. Okay, but
I think the key there is with scale, Greg. So
yes,
we'll
with
keep
scale.
working on it if you do.
Of course. So I've always, I thought it was interesting because Wei, and on the panel with Martin, he kept on referring to dimensional as an active manager. I've always thought of it as a quant manager. I mean, how would one classify the strategy?
There's multiple ways to label it, right? So active in a sense of like tilts. So it's not like the exact index exposure that you have. We just don't do it by forecasting and subjective views and like this is the outlook and we believe that the market will do something. And so it's a rules-based approach where you tilt to like known factors. You expect these premiums to materialize at one point. What Wei already alluded to, we don't know when exactly these premiums show up. When we say we have a long-term investment approach, we say it for a good reason. It's easy to say it because we don't know when these premiums show up. And exactly to Wei's point, that's why you want to be multi-factor. If value doesn't work now, then quality, say profitability may work. And understanding how these things interact, how you can use shorter-term signals to like get to a good outcome, that's where the art to factor investing comes into the picture.
Yeah, I think the key there, Greg, is that like passive vehicles, we're not guessing on any prices. We accept the prices for what they are. And that's okay. We can use that to help build portfolios that give you higher returns without guessing, and that's the key.
Okay. And a question from the audience. What is the biggest mistake Dimensional has made in the last 20 years?
It's not investment related. I think it's marketing related. I think we have a really good story to tell to people, to give them an idea of how there's an alternative way of investing other than just taking index or thinking you have to be active. And we work hard at it, but I think we can do a lot better job of being vociferous with a lot more people that there's an alternative that can work well for you. So in retrospect, I would say that's our biggest mistake.
Let me add a couple of things, because there's many ways to do quant. You can, in a quant way, try to predict what will happen in the future. You can focus on 200 factors rather than the ones that we have right now. To the point that we made earlier, we never had to close a fund. Has partially to do with the rigor in the research process, that the signals that we use, we never had to turn one off. Never. So the research that Wei does on a particular signal, you do that, then it gets peer-reviewed. Pharma friends may look at it, and another page they may go through the same data and see if it still works. Out of sample, can we implement it net of like the transaction costs and so forth? And I think by setting the bar that high, you basically put yourself in a position, exactly to your point, that we launch funds, so we never have to close them.
Okay, that's a good way to end the panel. I think we're just about running out of time. Thank you very much, guys.
Greg, thank you.
Yeah.